Welcome back to the deep dive. We're going to jump right into a question that I think holds immense weight for millions of people.
It's one of those questions that's about more than just money, isn't it? It's about survival.
Absolutely. So, what is the single most pressing, maybe even terrifying financial reality for a low-income family, especially one, say, in a place like California?
Well, we often talk about rent or, car payments, but the real answer, the thing that keeps people up at night, is all about healthcare.
Exactly. It's the constant agonizing fear of losing your health coverage. That's Medi-Cal in California, just because your income went up by a tiny amount.
It's the eligibility cliff. It's this bizarre paradox where you're almost punished for trying to get ahead,
Right. Imagine you get a small raise, or maybe you start a tiny side business.
or even just get a small dividend from an investment you were hoping would give you some security.
And that tiny bit of extra income, it can trigger a catastrophe. You could lose your health coverage, maybe even food assistance. The system basically undermines your stability.
It's this financial tightrope walk. You have to stay, just poor enough to qualify for the help you need to survive.
It's an impossible situation. But today we're going to look at how a pretty sophisticated financial tool might offer a legal way to navigate that tightrope.
And before we get into the nuts and bolts, I just want to say thank you. The response to our last deep dive on STRC was just incredible.
It really was. In that one, we talked about STRC, that's Strategy Inc., preferred stock, mostly as a tool for high-income folks, right?
Yeah, people nearing retirement looking to defer taxes, or white-collar workers worried about AI taking their jobs. We framed it as a wealth management tool.
And that brought in this wave of questions from listeners, all basically asking the same thing.
The question was, okay, that's great for the wealthy, but what does this actually mean for low-income families?
Can this, return of capital feature actually help protect someone's Medicaid? And that question, that's our mission for today.
We're going to venture into the absolute basics, how this thing called ROC, or return of capital, could be a lifesaver for protecting Medicaid plans in the 40 states that use a system called NGI.
We're using California as our main example just because every state has its own little nuances.
But the core tax idea we're exploring applies pretty much anywhere that NGI is the rule.
And I have to say, I really wish we had video for this one. Some of these concepts, you just want to draw them on a whiteboard.
We'll get there.
We will. And as you know, we need to hit 1,000 subscribers to get the funds for this new AI video editor our team is so excited about. So if you haven't already, please subscribe and maybe share this in your groups where you geek out on, deep finance or deep science. Your support really does make this happen.
All right, so let's set the stage. Let's talk about the reality of Medi-Cal, MGI, and this eligibility cliff.
Okay, let's unpack that. For a family on a tight budget, health coverage it's everything, isn't it?
It's more critical than almost anything else. A single trip to the emergency room without insurance can mean total financial ruin.
So in California, that safety net is Medi-Cal. And to get it, you have to pass a test.
The test is called MGI, Modified Adjusted Gross Income. It's the absolute gatekeeper.
And that gate it's incredibly narrow. What's the actual number we're talking about for, say, a family of two?
For one adult and one child, the annual income limit for MAGI Medi-Cal is right around $28,208.
Wow.
Yeah, it's about 138% of the federal poverty level. If your MAGI goes one single dollar over that number,
Yeah.
you're on the cliff.
Okay, so we have to break down NGI itself. That term, modified adjusted gross income, it's a mouthful.
It is, but the name tells you what it is. It starts with your federal AGI, or adjusted gross income.
An AGI is basically all your taxable income, right? Your wages, interest, dividends from most stocks, capital gains. It's the whole picture of your financial life that you report to the IRS.
That's the starting point. But then, to get to MAGI, they make some modifications.
What kind of modification?
They're crucial. They basically add back certain kinds of non-taxable income, things that the IRS lets you exclude, but that still represent cash you have.
Like what?
The big one is tax-exempt interest, like from municipal bonds. The idea is, if you receive the cash, it should count towards your ability to pay for healthcare, even if it's not taxed.
So given that, how dangerous is getting traditional investment income if you're a low-income family just trying to build a small safety net?
It is extremely dangerous. Let's take that family of two again. Say they make $27,000 a year in wages.
Okay, they're safely under the limit.
Right. Now they decide to buy a normal dividends stock, a utility company maybe, and it pays them an extra $2,000 a year.
That sounds like a good thing, a little extra cash flow.
It should be, but that $2,000 dividend is taxable income. It shows up on their tax forms, and it immediately increases their AGI from $27,000 to $29,000.
And $29,000 is over the $28,208 limit.
Exactly. They succeeded in getting $2,000 in cash, but they just risked losing thousands of dollars in healthcare coverage. The investment was a net negative.
So the goal has to be incredibly specific then.
Absolutely precise. You need to find a source of cash flow that gives you real, spendable money.
But that is legally invisible to the AGI calculation in the year you get it.
That's it. You need income that doesn't look like income when the tax man comes knocking.
Which sounds impossible. How do you get cash that isn't from profits or interest?
And that brings us back to STRC and this very specific legal structure called return of capital.
So let's introduce the instrument again, but let's really break down the name. STRC is the variable rate series, a perpetual stretch preferred stock from Strategy Inc.
That's a lot of jargon. Let's start with preferred stock.
Okay.
It's a hybrid. It's equity, like a common stock, but it acts more like a bond. It pays a set dividend, and if the company goes bankrupt, preferred holders get paid before the common stockholders do.
And what about the word perpetual?
Perpetual means it never matures. A bond has an end date where you get your principal back. STRC can, in theory, exist forever. The company doesn't have to pay you your principal back, just the distributions.
Okay, and the weirdest part of the name. Stretch preferred stock. What is that?
That's a term specific to this company. It basically tells you where it sits in the pecking order. Stretch means it's junior to some of their other preferred stock. It's a clue about the risk profile.
But the main appeal, the reason we're even talking about it, is that its distribution, that 10.5% yield, is classified as a tax-deferred return of capital, or ROC.
And this is where we have to draw a very, very bright line between ROC and a normal dividend.
Let's do it. A normal dividend is
A distribution of the company's profits, their earnings. The company makes money, it shares that money with you, and it's immediately taxable. It increases your AGI. Standard stuff.
Okay. So ROC, if it's not a profit, what is it?
The IRS treats it as a return of your own money, a reduction of your original investment. You're just getting your own principal back piece by piece.
So it's a cash flow event, but it's not an income event.
Exactly. And because it's not treated as income in the year you get it, it does not increase your AGI.
And this is verified on the tax form, the 1099 DIV.
Yes. A normal dividend is in Box 1A. A return of capital distribution is listed in Box 3, non-dividend distributions. That's the magic box.
This feels like financial alchemy. How can a company with, billions of dollars in assets claim it doesn't have any taxable profits to distribute?
This is all about the difference between accounting for Wall Street and accounting for the IRS. They are two different worlds.
Okay.
On its financial statements, Strategy Inc. reports huge profits, like billions of dollars in profit from the rising price of their Bitcoin holdings. That's for their shareholders, using GAAP accounting.
But the IRS doesn't care about that.
The IRS only cares about something called tax earnings and profits, or tax E&P, and you only generate tax E&P when you realize a gain, when you actually sell something for a profit.
Ah, so all those billions in Bitcoin gains are, for tax purposes, unrealized. They're just on paper.
They're just on paper. And the company's famous never sell strategy isn't just a philosophy.
It's the entire mechanism that generates the ROC.
It's the tax deferral engine. By never selling the Bitcoin, they keep their tax E&P negative. And if there are no taxable profits to distribute, the cash they pay out is, by law, classified as a non-taxable return of capital.
So if they ever broke that mantra and sold a bunch of Bitcoin,
The whole thing could flip. The tax E&P would become positive, and the next distribution could become a fully taxable dividend, destroying the entire benefit for our low-income family.
which brings us to the core of this whole deep dive, the MAGI loophole.
This is the moment it all comes together.
So let's ask it directly. Does that return of capital, that cash in box 3, count toward modified adjusted gross income in the year you receive it?
The answer is a clear, definitive, and very powerful no.
Walk us through that one more time. Why is it excluded?
Because the MGI calculation starts with federal AGI.
Right.
And since the IRS considers ROC a return of your own principal, not income, it is legally excluded from your AGI. It has a zero impact on AGI.
And if it has a zero impact on AGI, it has a zero impact on AGI.
The cash flow is completely shielded from the eligibility calculation in that year. It's a game changer.
It means a family can get thousands of extra dollars in cash flow a year without going over that cliff.
That's the power of it. It defers the income, and that deferral protects their immediate access to health care.
Let's run the example again. The family of 2, the MEGI ceiling of about $28,000.
Okay, Let's say their wages give them a baseline AGI of $22,000. They're comfortably eligible for Medi-Cal.
And they need, say, an extra $6,000 a year just to make ends meet.
So they invest in STRC, and over the course of year one, they get $6,200 in cash distributions.
Now, if that were a normal dividend, their AGI would shoot up to $28,200. They'd be right on the line, probably triggering reviews and just a mess.
It's a total mess. But because it's ROC, it's non-taxable in year one. They get the $6,200 in cash.
And their reported AGI for MediCAL stays at $22,000.
Yeah, they get the cash they need and they keep their health insurance. It turns this high-yield instrument into, really, a defense mechanism.
I have to pause here. It's an incredible tool, but doesn't the fact that this is even necessary just show how broken the system is?
That's a really profound point. It
Yeah.
absolutely does. The system is designed with these perverse incentives that punish you for taxable success.
So this isn't some celebration of clever finance. It's a pragmatic workaround for a flawed system.
It's a necessity. It forces families to become amateur tax engineers just to survive that transition from needing help to being independent.
Given that reality, verification is everything. You can't afford to get this wrong. How does an investor make absolutely sure it's being reported correctly?
You have to be diligent. When you get your Form 1099 DIV from your broker, you must check that the money is listed in Box 3, non-dividend distributions.
And what if it's not? What if the broker messes up and puts it in box 1A?
That's a potential disaster. It would immediately count as AGI and could trigger the loss of benefits. You'd have to contact the brokerage right away and demand a corrected form. The whole strategy hangs on that one little box on that one form.
So the immediate benefit is clear. Now we have to talk about the risk. You don't get a 10.5% yield for free.
No, you don't. And this is where the traditional investing world, the Boglehead philosophy, would have a major problem with this.
Right. The Bogleheads are all about diversification and safety.
Exactly. Their idea of a fixed income investment is something like BND, the big bond market index fund. It holds thousands of super safe, mostly government-backed bonds, almost zero risk of default.
And they would reject STRC because it's the exact opposite of that. It's single issuer credit risk.
100%. Your entire investment is tied to the fate of one company, Strategy Inc., and one very volatile asset, Bitcoin. The argument is that no yield is high enough to justify that kind of concentrated risk, especially for a low-income family's savings.
It's a huge ethical consideration. But the counter-argument is about the structure, right? The company's massive treasury.
Right. And there's a paradox here. Legally, the stock is uncollateralized. You don't have a direct claim on any specific Bitcoin.
But at the same time, it's economically backed by a $71 billion treasury of Bitcoin.
Both things are true. Its safety depends on two things: the value of those assets and its place in line if the company ever goes bankrupt. The liquidation waterfall.
Okay, let's make the waterfall easy to understand. It's just a pecking order, right? Who gets paid first in a disaster?
Exactly. First in line, tier 1, is all the senior debt, the money the company borrowed. That's about $8.24 billion. They get paid first no matter what.
Then you get to the preferred shareholders.
Right. And even within that group, there's a pecking order. The most senior preferred stock gets paid next. And then comes STRC, our instrument.
And what's below STRC? What's the cushion?
Below STRC, you have billions of dollars of more junior preferred stock. And then at the very bottom, all the common stock, MSTR. All of that has to be wiped out before STRC loses a penny of principal.
Okay, so let's stress test this. The company claims the principal is safe even if Bitcoin crashes 80%. Is that true?
Let's run the numbers. An 80% crash would take the Treasury's value from over $71 billion down to about $14.3 billion.
Okay, you start with $14.3 billion. First, you pay off the senior debt of $8.24 billion. You're left with about $6 billion.
Correct. Then you pay off the most senior preferred stock. You're left with about $4.8 billion.
And the entire STRC claim is only $2.8 billion.
So you can pay it off in full, and you still have $2 billion left over. The principal is absolutely protected in an 80% crash.
So the principal seems pretty secure, but what about the dividend, the actual cash flow? They owe $640 million a year in dividends, but have like $50 million in cash.
And that massive gap is why S&P gives them a junk bond rating. They have the assets, but they don't have the cash flow from their regular business to pay the dividend.
So how do they pay it?
This is the wild part. They use what's called the circular funding model. They raise the cash to pay the dividend, by selling new shares of their common stock, MSTR.
Wait, they sell their common stock to pay the dividends on their preferred stock.
It's a high-wire act.
Hmm.
They're constantly selling a little bit of MSTR stock into the market, especially when the price of Bitcoin is high, to raise the cash they need for that $640 million annual bill.
That feels incredibly fragile. It's totally dependent on the market wanting to buy their stock.
It is. If Bitcoin crashes and the stock market gets choppy, that funding model could break down very quickly. And that's the primary risk to the dividend payment.
So what's the ultimate fail-safe? What happens if they can't sell stock anymore?
This is the fundamental contradiction. The company's own SEC filings are clear. If all other financing fails, the last fail-safe is the forced sale of Bitcoin to meet their obligations.
Including the STRC dividend.
Including the STRC dividend. So the entire ROC feature is built on them never selling Bitcoin.
But the ultimate guarantee of the dividend is that they will sell Bitcoin if they have to.
It's the ultimate paradox. The threat of the sale is what guarantees the payment, even though the sale itself would undermine the tax structure. It's a fascinating and risky setup.
Okay, so we've covered the immediate benefit and we've covered the risks. Now we have to talk about the hidden pipeline, the future tax bomb.
This is maybe the most important part for the listener to understand. The ROC feature only defers the tax. It doesn't eliminate it.
The tax bill is just postponed.
Yeah.
How does the IRS make sure they eventually get their money?
Through something called the cost basis adjustment. It's mandatory. Since you're getting your original investment back, you have to subtract the amount of ROC you receive from your original purchase price.
So your cost basis, what you paid for the stock, gets lower and lower over time.
Exactly. And this is something the investor has to track themselves. The broker might not do it perfectly. You need to keep all your records.
Let's use an example. I buy 100 shares for $9,000.
Okay? And over 3 years, you receive $1,500 in ROC distributions. You have to subtract that from your cost basis. So your new adjusted cost basis is now $7,500.
And the tax comes due when I finally sell the shares.
Right. The capital gain is your sale price minus your adjusted cost basis. So because your basis is now artificially low, your taxable gain will be much bigger.
So if I sell for the same $9,000 I paid, I don't break even from a tax perspective.
Not at all. Your taxable gain is $9,000 minus $7,500. You have a $1,500 capital gain that you have to report as income in the year you sell.
And this is the critical point, that future capital gain will count towards AGI and NGI. This is the delayed surge.
The delayed surge, the perfect term for it. The family successfully uses ROC to stay eligible for Medi-Cal for years. But the moment they sell the investment, maybe to use the money for a down payment on a house.
That one-time sale creates a huge spike in their taxable income.
Let's run our family example one last time. Baseline AGI of $22,000. They've shielded $9,000 in ROC over the years. Now in year 4, they sell and realize a $9,000 capital gain.
Their AGI for that year instantly jumps from $22,000 to $31,000.
Like is well over the $28,000 MGI limit. They avoided the cliff for years, only to be thrown over it by the act of selling.
And since medical eligibility can be determined on a monthly basis, that one big sale in, say, January could knock them off for that month, couldn't it?
It's a huge risk. That one spike in monthly income could trigger a redetermination, disrupt their care. It makes the timing of the sale incredibly strategic.
It's not just a financial decision. It's a piece of choreography you have to plan around the state's bureaucracy.
It really is.
So let's give the listeners some concrete, actionable next steps. What do you do?
First, documentation. You have to be relentless. Keep every brokerage statement, every 1099 DIV, and every Form 8937 from the company that details the basis adjustments.
Second, talk to a professional.
This is not optional. You need a tax preparer who understands low-income tax situations and the MGI rules. You have to model out what a future sale would look like for your AGI.
And third, you have to talk to the agency itself.
Call your medical county office. Ask them directly. How do you treat a one-time capital gain from selling stock for monthly eligibility? Get the answer from the source.
And finally, what can they do to manage that delayed surge when they do decide to sell?
The best strategy is to try to spread the gain across tax years. If you can, sell half in December of one year and the other half in January the next. That splits the income spike across 2 different AGI periods, making it smaller and more manageable.
One last warning. We've been talking about MAGI MediCAL. What about programs that are asset tested?
That's a critical distinction. For programs for the aged, blind, or disabled, they often have an asset test, not just an income test. In that case, the cash you get from ROC counts as a resource the moment it hits your bank account.
So it could push you over the asset limit, which is often really low, like $2,000.
Exactly. So this ROC shield really only works for the income-based MAGI categories.
This has been, wow, an incredibly complex and high-stakes deep dive. So before we sign off, we have to say this one more time.
We have to. We are analyzing the tax code and financial documents. We are not tax advisors or lawyers.
This is absolutely not formal advice. Before you make any decision, please talk to qualified professionals and your local social services agency.
The relationship between ROC and MAGI is a perfect example of financial engineering deferring a social cost. The tax is the obligation, and the ROC is the legal tool to delay it.
And that means for the savvy person on this financial tightrope, the question isn't if the tax will hit, but when and how. How do you time that sale to cause the least disruption?
The decision to sell becomes just as important as the decision to buy. It requires the low-income investor to become a master planner of their own eligibility.
It really does. And we want to remind everyone listening that the content we create here is totally open source. We build it from the sources that you share with us from all over the web.
And we invite you to share more sources in the comments, especially if you have real-world experience with how a capital gain affects medical reporting in your state. The goal is a true symbiosis of artificial and natural intelligence.
Our AI can analyze the financial structure, but we need human intelligence for the on-the-ground context and critique.
And yes, we're always looking for human collaborators. If you're a CPA, a financial analyst, a medical caseworker, anyone who can review our content before we publish, please drop a comment. We want to make sure this is as accurate and as helpful as it can be.
Thank you so much for joining us for this crucial deep dive.
Keep searching.
Keep the quest on, as always.